Welcome to Property and Finance by Shore Financial, your go-to podcast for the latest insights and trends in the property and finance world. I'm Theo Chambers, CEO of Shore Financial, and together we'll explore market updates with experts in this field and provide practical tips to help you make informed decisions in the ever-changing landscape of property and finance. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast. Ladies and gentlemen, welcome to another episode of our Property and Finance podcast. Today, we're going to talk about the federal budget impacts, not the federal budget changes. I'm sure everybody is sick of hearing about the overall changes of the federal budget, and I'm hopeful that people are across the changes by now. So instead today, we're going to talk about what impacts we're already witnessing, things that we think people haven't fully digested yet. And we're going to bring on a special guest, a guest that we recently did a webinar with, Brad Seeto from Bramelle Partners.
Thanks for having me, Theo. Glad to be here.
So Brad and I did a webinar a couple of weeks ago. We had record registrations, up to 600 guests on our registrations. It was a very popular webinar talking about all the federal budget changes. Brad also founded his business pretty much the exact same timeline as us, with a similar storyline. It's founded Bramelle Partners as an accounting practice in 2013 in Alexander Street, Crow's Nest, in the same co-working building that we did in the same year. Pretty funny story. We're probably crossing paths in the hallway, and here we are.
It's only taken us 13 years to come back together, sort of full circle. So there we go. And we're actually across the road from each other now. So.
Yeah. We're literally now basically on the same street, just, instead of down the hallway, down the street. So, we've had a very interesting reconnection where we did this webinar recently, and we had record engagement all off the back of this federal budget, which has been extremely disruptive, for lack of a better word. Like I said, I don't want to go into detail on the overall changes because hopefully listeners by now are across, those changes. But let's more focus on the impact and what we're seeing. And based on the questions that we had in our Q&A in our webinar, let's unpack maybe where there seems to be a little bit of a lack of clarity or uncertainty on where investors are best focused. So, Brad, firstly, thanks for coming on board. We'll touch on the changes in a high level. So negative gearing, everybody knows, is now reserved for brand new properties. Originally, brand new property purchase for investors were only about 20% of overall activity. So what I mean by that, there's about 35-40% of total total lending goes towards investments. So investor lending makes up about 35 to 40% of overall lending, and about 20% of that is going towards purchasing brand new dwellings. A lot of people think brand new dwellings means units in off-the-plan purchases, but it's also just house and land packages and a duplex of the like. Westpac's forecasting that to increase to 40 to 50%, given that now negative gearing changes are reserved towards brand new properties. Hopefully that would then stimulate supply, because at the moment we've had a fundamental issue of supply. Before we move on to CGT changes, I want to just talk maybe to your experience internally with your client base, given you're probably across people factoring in negative gearing to their cash flows. How much of an impact do you feel that has to your investor database?
It's a question that's come up a lot. It does have a huge impact. Obviously, those investors who are negative gearing, they are expecting or were relying on the cash flows coming back from tax refunds over time, and general strategy was to rely on those cash flows, maximise the benefit of the negative gearing. But effectively, you're getting subsidised for the capital gains later on down the track, and you do sort of get some benefit there because ultimately, with the CGT discount, you're only paying concessional tax rates on that, i.e. 50% of the gain. So with that gone and also the capital gains now being taxed under indexation, ultimately at sort of the highest margin rate if you're on the highest tax bracket, you sort of got to weigh up whether it is beneficial to actually compensate that loss now, because you're not actually getting the uplift at the end of the investment when you do sell. So we're sort of having conversations around, do you really subsidise that loss? Is it more of a yield play rather than a capital growth play now? And it probably is more leaning towards a yield play than a capital growth play when you're looking at investors buying property.
Yeah, we're definitely seeing in our business that there's a shift in investor mindset. I wouldn't say investors have dissipated entirely. We still see investors being active, but they're now looking at a different type of strategy. They're chasing cash flow. Maybe they're purchasing at a lower LVR, meaning reducing their purchase price to achieve a lower LVR. So it's cash flow neutral or just fractionally negative, or having a bigger deposit. But I just want to go back to a point you mentioned there. Negative gearing is still there, new build or not, right? For established dwellings, it's still there. You're just carrying it forward against a future gain, right? Do you not see it that way?
No, I don't see it that way. Once again, as an investor, you've got to come back to cash flow impacts. Typically with negative gearing, that was around, you get that cash flow back when you lodge your tax return. You could actually get it back even earlier if you do an income tax withholding declaration. That cash flow is just not going to come back. It's basically going to come off your final tax bill later on down the track when you sell. So that cash flow is effectively maybe 5-10 years down the track when you ultimately sell. So if you're looking at sort of investment time frame and net present value and all of that, it does have a significant impact on I think your mindset of an investor. And I think that's probably the problem with the regime that's being implemented, is that it will change the psyche of the investor in terms of do I still invest in existing homes and negative gear this? It's a question that's definitely got to be pondered.
I'm sure your phone's been blasting the last few weeks, or it's over a month ago now since the federal budget. Is that the reaction of people now? People that were preparing to purchase an investment are now reconsidering strategies and maybe looking at an alternative?
Yeah, absolutely. So I think the strategies they've got to think about are they really willing to basically subsidise a loss now, which they're not going to get back, their marginal rate of tax at the end of the year, in order to continue to hold that investment for that capital growth down the track. Now, it is a material impact, as I said before, and so some of the strategies which you mentioned are very valid. Don't borrow as much. But one of the other strategies is also, well, let's just increase the rent. And if you're looking at what these policies were aimed at in helping younger people get in the market, increased rent means less disposable income to save. Means a longer time horizon for saving for these younger people to get in the market. Also on new builds, if you're looking at getting into the market for a new build as a first home buyer, you now got more competition as well. So a lot of these policies or how they've framed it seem to be counterintuitive of what the government's out there professing.
And when we've got a housing crisis, meaning an affordability crisis, sure, we might soften growth and competition by making investors less attracted to investing in property. But then on the contrary, on the flip side, tenants and renters now have an affordability challenge if their ability to save a deposit is limited because of higher rents.
Yeah, well, typically individuals, that's normally their highest cost, right? The rent. And there's history behind this as well. So, when negative gearing was cancelled back in 85, rents went through the roof and it was basically repealed 2 years later. And we've had, something a bit more closer is New Zealand sort of did the same thing as well, and rents went through the roof as well. Although there are obviously other factors with immigration and COVID and whatnot. But there's a bit of history there and a bit of data there that suggests rents will actually increase. And from an investor point of view, I don't think sitting pat on charging the same amount for rent and taking the loss to the same amount when you're not going to get a benefit is going to factor really in your calculation. I think you've really got to think about it from an investor point of view. Or you could just sell out and buy a different investment class as well. So
that's assuming that you're purchasing underneath the new regime, right? If your negative gearing is still maintained on the existing properties, so it's mainly reconsidering for strategies moving forward, which it's quite unfair because it means that existing landlords have this legacy tax entitlement, and the ones that were trying to create wealth and get ahead are the ones going to be struggling moving forward. So I guess going back to, you made a comment there that history. If you look back at history, well, something else that we should look back at history on is this current federal government, where they put forward the Div 296 changes. This is the same government that proposed tax on unrealised gains in superannuation, but that didn't get legislated. The big question is how much of this actually gets legislated in the current proposition on what's being put forward.
Well, I don't think the game is over yet, to be perfectly honest, Theo. There's obviously been a lot of noise since these budget announcements have been proposed. If you read in the paper every day, they're going to have carve-outs, they're not going to have carve-outs. But there are a lot of disappointed people out there in the market at the moment, and I don't think the Labor government had forecasted as much dissenting voters from their own voting bloc. And I think as long as people still make a lot of noise about it, the announcements which they did announce may actually change by the time they're actually legislated.
Well, they broke a promise to their own voters. They campaigned countless times that they wouldn't touch capital gains tax or negative gearing. It cost them the 2019 election, I think it was. So yeah, of course, their own voters feel like the government they supported has lied to them. So I do, to your point, I support the people causing some frustration in the marketplace. What we've seen recently, actually, which is surprising, is the major banks actually now getting a bit vocal. The only one that's been a bit quiet has been Matt Common, but the other CEOs are saying that this won't be good for business. I think there's it's like 11 billion of shorting positions across the major banks at the moment. Let's go back to the actual changes then. So I feel like we've covered negative gearing. Everyone understands those changes there. One unintentional consequence and one maybe subsequent impact is that these negative gearing changes were reserved toward residential property, meaning that you can still negatively gear commercial property, although you typically borrow at a 60 to 70% LVR for commercial purchasing or investing. So at that level, you should hope that it's positively geared, especially because commercial properties tend to have a higher yield. However, if you're using equity in an existing property to help form your deposit, that if it is then overall negatively geared, you can still expense the overall debt, which is something we're already seeing investors digest and react to. So in our Sure Invest fund, our commercial syndicates that we do with our clients, we actually saw record registrations in the last few weeks. So already there's a pivot to a different section of the market. Moving on to CGT. Now, the part that I wanted to cover, which was something that came up in our webinar, is an actual comparison of the new system versus the old system. So a lot of people now are across, that the 50% discount is gone and there's new cost base adjusted by inflation to calculate your new net gain. Very confusing. I don't know how investors are going to be able to make a decision, especially let's say in share trading. If you own some shares for 2 to 3 years, how do you figure out the inflation and the cost base to make a decision based on today's market price of shares? It's overwhelming for investors, right?
Yeah, absolutely. It's not easy by any stretch of the imagination, and I think the two beneficiaries from these proposed changes are valuers and accountants.
Definitely.
But yeah, it's difficult for the best of us, and I did read one of the comments that they wanted to make this simple, and it's not simple by any stretch of the imagination.
No, definitely not. The whole point they got rid of it in the first place under Costello, I think it was because it was just too hard to calculate and too hard to track and measure, right? Because inflation changes now on a monthly basis. We report, even though we had the monthly indicator now, we actually report it on a monthly basis. So it's going to be changing. And in the last 5 years, we've seen inflation go up on a, let's say, quarterly, maybe biannual basis, up and down significantly, like a yo-yo almost, dancing between 3 to 5%. The unintentional consequence, in my opinion, is that people used to invest in share trading and rely on that 50% discount. And they would buy shares and after 12 months, consider selling, because if they made an attractive gain, you're paying, let's say you're in the top tax bracket, call it 23.5% CGT. That is now no longer. And you're basically paying twice the amount of tax if you have an attractive share trade over a short period of time. And generally, people take a shorter term mindset towards share trading than property investing. And the only way that you really can justify the same position is by having a very long-term view towards your investment, where it's not really the case anymore with share trading. I feel like the share trading that we witness with our clients is people, let's say, first home buyers investing in shares to accumulate a deposit, and maybe that's over a 3 to 4 year period, so they'll be paying more tax. Or just maybe people that have bought a home and they've got some spare cash they want to invest whilst accumulating savings for a renovation. So unless you're taking a very long-term view, those investments now look less appealing and you pay more tax, yet property remains somewhat unchanged over a 6 to 7 year period. Now, I'm going to talk to some exact specifics. So the example I've run here is let's say you bought a property for $1 million and you sold the property for 1.5 and you had a $500,000 gain. Under the old system, and I should also say this is over. We're going to use a 6 year period to calculate the cost base adjusted cost base. Over a 6 year period, that 500 gain in the current system is effectively halved, and the net after tax money works out to be about $382,000. With the new system, now, if we assume a 3% inflation rate, which is actually below where we've been historically just recently, before COVID, we couldn't get it off the floor of 1.5%. The difference is not that substantial over 6 years at 3% compounding. It's $356,000 versus that $380,000. So it's a $30,000 difference. So I don't see, if investors actually do the math like that, which the problem is that it's hard to do that math because it's a little bit, you have to make some assumptions on inflation. If you do the math, it's not the end of the world, right? The bigger issue is just the negative gearing and cash flowing it.
Yeah, it really depends on, once again, back on your assumptions, right? So what is your ultimate growth? So I think from a tax point of view, if your growth rate's in line with inflation, ultimately you shouldn't have to pay any tax because the real gain's zero under the new indexation. And you might be in front on that basis if you're comparing that to CGT discount where you actually do pay tax under that scenario. Where you're going to get the larger variances is where there's a difference between the inflation rate and the actual final growth rate. And that's where you're paying tax at the full marginal rate versus 50% discount less the inflation rate.
Which is actually then only really a true gain, because if your cost base, if inflation is relatively similar to the growth rate, then you haven't really made a true gain.
Yeah. And that's where, you've got the business community up in arms. They don't have a huge cost base. Generally, majority of the proceeds is the gain. So, yeah, instead of paying tax on half your gain, you're pretty much paying tax on all the gain because your cost base is very minimal. But, yeah, that's definitely going to change. Property, generally tried and tested. It's probably a couple of percentage points above inflation to allow for the risk. Whereas shares, you might have a bit more of an aberration to the mean depending on what you're investing in year out, and whether you've got some winners in your portfolio or not. So, yeah, and I think what you've said around people investing in a shorter time frame for shares, especially first homeowners, that's definitely true. You do it for the liquidity. The days are gone where you can just stick money in the bank, put extra savings in there, accumulate interest. That's been gone more than a decade ago because the property prices just went way above what you could make for interest in the bank. So everyone's had to take a bit more risk on by investing in the share market, and now having this minimum 30% apply. no CGT discount. Once again, it hurts you if you're trying to get into the market and build that deposit up.
And gone are the days where investors, the baby boomers, which we'll probably touch on, used to buy, let's say CBA as a share and hang on to it for 10, 20 years. Gone are those days for modern day investors. Like no one really buys shares and hangs on to it for that extended period of time, mainly because of I guess call it a liquidity crisis. People obviously sometimes are scraping the bottom of the barrel to form a deposit to purchase the property. Sorry, they're sometimes borrowing money off family or getting a gift off family to get to that minimum deposit level. So you're never really able to keep a share portfolio on the side to get your foot in the property door.
No, look, to get your foot in the property door without sort of any other help. Look, you've got to take an element of risk these days. Let's be honest about it. Like even if you did get a very good mark in the HSC, went to university, got a degree there, ended up with a high-paying job. Like at the end of the day, 200 grand is not much as a graduate to build a deposit up whilst you're renting to then get in the problem. Like you've got to take some element of risk there, and I think really the only way without help from the bank of mum and dad is typically you've got to go build something and sell it, or you're effectively got to get lucky. And in the last decade, it's been crypto. Now, if you go and undertake any of that with that element of risk, and let's be honest, you effectively by taking those two routes, you're risking losing it all. But if you win on the other side, you're going to basically lose double the amount of tax that you would have under the CGT discount. So, yeah, there's a lot of people saying, well, what's the point? And now you're going to have to fight, higher rents.
Yeah.
Less investors in the property market means more pressure on rents. Staying at home longer. Sorry, parents. But that's the reality I think that the younger people are facing, and it's a bit of a shame. Like I've got kids as well. You've got to sort of ask them where is their chance to just make it on their own, and I think a lot of parents would be a lot more happy if children are more independent, made it on their own rather than getting a handout from mum and dad.
Yeah, it is a real challenge for the next generation because we've basically limited their ability to create wealth in any way, shape or form. And they've already got their own challenges. They've already got AI as the competition for the workforce, and the affordability crisis in housing. It's not driven by these tax policies that Jim Chambers likes to drive as his narrative. It's driven by a debt to income ratio that has grown so disproportionately over the last 20 odd years. But that's mainly because people 20 or 30 years ago, there used to be one income supporting household debt. Now there's two incomes supporting household debt. Most families have both couples or both individuals working. And people are committing more of their overall income to their mortgage because Australians put more emphasis on owning a home than anything else. It's actually the last sort of tax-free investment or tax-free, let's say, vehicle you can create wealth in. And I guess on that point, talking about impacts from the budgets, that's something we've already seen overnight, instantaneously. So we've been having discussions with our clients where some were considering purchasing an investment. They had some cash in their offset. They were happy where they live, and they thought, I want to create wealth and do something with the cash in my offset. And they were looking at buying an investment property. Now they're just pivoting to upgrading the owner-occupied home because it makes sense from a tax perspective. What's your views on that? Changing a strategy, just putting money in the home.
Well, we've seen a lot of that. So yeah, coming back to sort of tax-free environments, really at the end of the day, you've got main residence exemption and probably superannuation under the 2 million cap that we have at the moment, and that's probably it.
Which is still not tax-free. It's just a more favourable tax environment.
Yeah. So we've had also different conversations. So there's these things called insurance bonds or education bonds. There is an element of tax-free gains in that environment, although it's a fairly narrow market in Australia. But that's starting to, I guess that will ramp up that particular avenue of investment. But I've also had a lot more conversations around, well, why don't we just buy a property for our kids now as their main residence? So that that conversation has increased quite a lot since the budget changes have been announced.
So buy a property for the kids if they can afford the repayments, though, is the challenge.
Yes.
But that's where the bank of mum and dad comes in.
That's where the bank of mum and dad comes in.
Yeah.
But ultimately, if they do sell, it is a tax-free environment. Assuming it's their main residence. But is that a better outcome, the tax-free gain, than going down the deferred negative gearing route?
So we'll move on. Trusts and companies. Everybody knows by now they put a 30% flat tax on trusts. I think an unintentional consequence there is that's going to affect both the middle and upper class, not just the upper class, because in our business we see trust being used for self-employed tradies and whatnot that disperse their income between themselves and their wife or children and whatnot. I think there was a lack of care into the double taxation, no tax credit for the trust paying into a bucket company. That just seems like it wasn't well thought out.
Oh, I think that was actually intentional.
Okay.
So the no credit flowing through to the bucket company, it just signals that the government just doesn't want you to use bucket companies anymore, and the end of story.
So let's just clarify what that actually means for people that don't talk this tax lingo as much as you and I. You pay 30%. So if you own your business in a trust, which most people do, you pay 30% on the profits that you pull out of the business through the trust. That's now what they're proposing is the flat tax rate. And trusts can't hold, just a discretionary family trust cannot hold profits. So it's got to be dispersed either to the beneficiaries or you could put it to a bucket company. Now, the bucket company traditionally paid between 24 to 30% tax, right?
It was a 30%. So a bucket company, the main purpose of that, it was a capture rule. So typically with a trust, you would distribute long-term capital gains. Highest tax rate you'll pay is 23.5% after taking into account the CGT discount. Then if you didn't need access to that income, you would distribute the rest to a bucket company and it will pay no more than 30%, assuming it's not being run by a business. General wealth management strategy would be to accumulate within that structure. You've got after-tax profits there to reinvest at 70%. Build the capital and investment income in that, and then when you have no other income in your own personal name, then that's where you could distribute it out. Typically that would involve retirement, kids turning 18.
So to go back to your point there, Brad, now they're paying 30% the trust tax and you get no credit on the trust tax and you pay another up to potentially 30% in the company. That's 60%.
Yeah, so you get double tax. So if you're going to any accountant, I probably wouldn't have to even say good accountant, like any accountant will know that just doesn't make sense. So you just wouldn't distribute to a bucket company. So ultimately, income within a trust will end up getting taxed at individual levels and minimum 30% or higher if their marginal tax rate is above that.
So it's amazing how quickly people innovate and pivot into different strategies. And what we're seeing already is instead of investing in a trust with a bucket company, they're cutting out the trust and looking at setting up a company as the investment vehicle. And this can be a strong accumulation vehicle. To your point, you've already touched on it. You only pay 30%, so you can reinvest 70% after tax money and keep the money in there, and you can choose how you want to disperse it, meaning that in a trust, you have to disperse the income annually, but in a company, you can keep the retained profits and then disperse the gain over time, pay different family members' wages, perhaps.
Yeah, so with a company, tax rate's 30%, you've got 70% to reinvest. There is no requirement at all to distribute those funds, so you can just keep reinvesting, get the power of compounding, compared to doing it in your own name, which you're probably getting an after-tax benefit, less the marginal tax rate, which is probably above 30%. And then in terms of getting the funds out of there, you can either structure the shareholding so that each person, well, what we're sort of typically going to advise on is each person within the family group gets a different class of share. So then you can distribute a dividend on each individual class of share. So effectively you can end up in a trust situation where you can get a discretionary sort of element of the distribution. Or you can do things like put some contributions into super, pay wages if there are justifiable wages and market salaries and whatnot. So There is a bit more flexibility, but it is a change. Typically why people didn't do this before was you didn't get CGT discount in a company. Now that's off the table. It doesn't really matter. So company seems to be going to be like the default vehicle going forward.
So just to go back to that point, companies were not attractive in the past because the 50% discount didn't apply. So does that mean moving forward, obviously the new cost base adjusted by inflation doesn't apply either to investments in a company?
That's true. So that's an interesting point in that the CPI indexation method doesn't apply to companies under the new proposed changes. So that's out. Funnily enough, the cost-based adjustments for indexation were applied to companies back in the 99 regime, and they took them off the table when CGT discount came in. But they're not putting them back in. So once again, the Treasurer has gone, we're going back to the 99 model.
Not quite.
It's not quite the same. But I'll also digress and say that, like, under the 99 model, we also had this concept of income averaging for capital gains tax, where if you did actually make a significant index gain, you could actually average that over 5 years. Now, that hasn't been brought back in either. And that obviously helped smooth the tax out over a number of years rather than just get hit with it all in 1 year. So without bringing the averaging in, we're actually in a worse place than what we were in 99. So, all the rhetoric around, we're just bringing this 99 thing. We were having 99 CGT adjusted indexation before. It's actually worse than that. So
it is. So let's just clarify then. That means that on any gains over, even if it's over 5 years in, let's say, share trading or buying an investment property, it's just a straight out flat 47% tax if you're going to pay it out to yourself that year. But something that we touched on, you can, let's say on that example I gave of a $500,000 gain, if you pay it out over 5 years, pay $100,000 out per year, maybe keep $400,000 invested and, sort of incrementally pay it out, you could end up in a more favourable tax environment than the cost-based adjusted inflation outside of it.
Yeah, so the idea would be to distribute out over a number of years, and what you're doing there at an individual level is lowering your average tax rate each year. So your ultimate average tax rate is less than getting hit in the 1 year. So let's take an example where it's 30% tax rate that, once again, in a company, franking credit does flow through with a dividend, unlike a trust does. If you had no other income, you could effectively get around 200 grand of gross taxable income. That's roughly where the average tax rate is, about 30%. So that means about 140 grand in cash. So you could get 140 grand in cash as a fully franked dividend and pay no further top-up tax, assuming you have no other income.
That's a good point. So that $500,000 gain, you could basically pay out over 2.5 years thereabouts at a flat 30%.
Correct. And the way that it currently structured is you could actually get a refund and pay 0%. Like if you distribute yourself $18,200 and get all the frank credits back, your actual end tax rate is actually 0% because frank credits are actually still refundable. We'll see whether that's the case in the future. But, you do have that to play with. So
that's the big changes that are causing the, let's say, the civil unrest. How do you feel about them as an accountant?
Oh, look, I think these changes are the biggest tax changes we've had probably since GST in 2000 came in. Ultimately, I just don't think this is fair. We've had the baby boomers, for example, who have had access to these tax rules. They've accumulated a lot of wealth through these. They've had family trusts. They've had bucket companies. They've had multiple people within their family group who they can distribute to at a lower tax bracket.
They had a big period of no capital gains tax.
Yes. They also had a period there where Costello allowed huge one-off contributions into super, $1 million each. I don't know if you remember that. But the contribution caps were a lot larger as well under the Liberal government. So there's been a lot of wealth creation and concessionally tax environments which the boomers have had access to. My biggest gripe about this is they've now accumulated all this wealth and they've done the right things. They've done it within the spirit of the law and done the right things. But the government's now come and said, well, actually, we don't think this is fair and we're going to change it. So everyone who's currently using these things, you can't use them anymore. I don't know why the baby boomers aren't hit, and there's some acknowledgement to say, well, actually, you probably accumulated a bit too much wealth. How about you tip back into the tax system and we tax them somehow to give compensation to the younger people who are now hit with these raft of changes, which makes it a lot harder for them to accumulate wealth. We've definitely got this sort of gap and this divide, I think, between the people who have accumulated under the old rules and the ones which are going to accumulate under the new rules. It's generally going to be a lot more tougher. And there's just no way to catch up.
And so you don't feel, going back, touching on my comment to the Div 296 changes around superannuation and taxes in super, you don't feel like that achieved enough? Because I guess the thresholds are quite high, right?
Well, yeah, they don't kick in until after $3 million. So, like $3 million, like that's a lot of money to have in super. Like, let's say you're making 5%. That's about 150 grand tax free that you're living off every year. You're not even touching your capital. Yeah, that's a lot of tax free money, and
that's also indexed as well.
Yeah, and you've got somebody, salary and wage earner making 150,000. Average tax rate at that level is probably around 26%. I don't see how you've got two people making the same amount of money, having a disparate amount of tax to pay. The other anomaly that I've also seen as well in terms of capital gains tax is if you're a non-resident and you're investing in the ASX and you don't own more than 10% of the actual share, so let's just say everything on the ASX, you actually don't pay any capital gains tax at all. So they have CGT-free status for non-residents who are buying shares on the ASX. And then potentially they're competing as well for buying an Australian property. So now you've got these two people potentially buying Australian property. One's living here, doing the right thing, paying salary and wages, buying shares. They end up having to pay minimum 30% on CGT. And then you've got a foreigner who's overseas, investing in the ASX, trying to build up their wealth. And then they're going to get to the property market a lot quicker. So you've got these incongruencies with different classes of investors and paying different rates of tax, which for what Dr. Jim Chambers is saying is intergenerational equality, I just don't think it's really equal at all.
So let's talk to what you would say would have been better there. Those thresholds for the Div 296 changes on super should have been lower thresholds.
Well, it's hard to say because like between $2 to $3 million, it's not really that much. Should it have been lower? Maybe should they just get taxed on superannuation generally and contribute something? Or should we go back to what Labor promised that they wouldn't do and like stop the refund of frank credits? Because if they are invested in frank credits, they're effectively getting that back as yield as well. So they actually have a negative interest rate. If you're thinking about that, in that perspective, they can lodge their self-managed super fund and they'll actually get a refund without actually having to pay any tax throughout the year.
So what are you hearing and seeing with your clients, the reactions here on all this? Like, are people, one of my topics to get to next was superannuation. Are people now looking at superannuation more as an investment vehicle? Are you seeing or hearing people now consider overseas markets for investing or locating? I've been personally having conversations with people about, whether it now makes sense to pay the exit tax and start earning an income in more tax favourable marketplace.
Yeah, so superannuation is a consideration. Still the biggest negative thing for a young person with superannuation, the money's locked up. But, that hasn't changed. Is it going to be still tax-free when they retire? That's probably a different question. So I don't think there's a huge amount of confidence still going with superannuation because there's not many more things to tax, let's be honest, after this.
Oh, there's one more big thing that's probably left on the table, which I think is inevitable, and that's the death tax.
The death tax,
the inheritance tax. I think that's coming because we're going through the biggest generational wealth transfer of all time from the baby boomers down to the next generation. So it would be the biggest tax grab of all time.
Yeah, I think that Div 296 tax on unrealised gains was the gateway to that. So the moment, you start taxing unrealised gains, it's effectively a wealth tax, isn't it? So I thought if that got up, then I thought that would have just ended up creeping up at an individual level, and I'll say, taxpayers with X amount of wealth, well, we'll take a little bit of that. Obviously, there's been a lot of pushback on that, so we'll have to wait and see. But yeah, overseas, we've definitely had a lot more inquiries about people moving overseas. What does this actually mean for you? Do I pay the wealth tax? Is it easy to accumulate income overseas and earn income overseas? And you've sort of got to weigh up, do I do that? Is the tax saving worth, the change in lifestyle? So it's really, I think, a test for the government is like, how much do you really love Australia if you want to continue on and you're still a high taxpayer and you're still paying a lot, and whether you still persevere and stay here.
Well, let's talk to that in a bit more detail in the sense that how does that work for people? So the conversations we're having is around people moving to, let's say, a country in Europe, because a lot of the European countries have high net worth tax policies, migration policies, where if you bring, what's considered high net worth in some of these countries is 500,000 euros into their economy, you can pay a flat tax rate of 100 to 200,000 euros on your global income, flat fee. The problem is that you can't be in the country in Australia for more than 6 months a year. Otherwise, you'll become a tax resident naturally here. But you could come here for 5 months a year, spend summer, and escape to the northern hemisphere for an all-round year summer, all year round summer, I should say. The hurdles and complications for people considering this: exit tax. So you've got to pay that unrealised gain, the tax on unrealised gains, basically on any assets you hold. So you're effectively treated as if you're selling every asset in your personal name, and you pay the capital gains on all those assets. However, if you have assets in a trust and the controller of the trust stays here, then that's exempt from the exit tax, I believe.
Yeah, that's correct. So the trust will need to maintain its Australian tax residency. So the moment you have a change of tax residency, whether it be an entity like a company or a trust or individually, you effectively have this triggering of a capital gains tax event, and you're basically paying tax on the market value of the assets when you leave. So that's certainly a strong consideration. But if you're a non-resident, you pay that exit tax and you leave, then really you're only subject to tax in Australia on Australian sourced income in the future. Now, there are some things that Australia don't tax as to non-residents, and as I said before, one is capital gains tax on shares, as long as you don't own more than 10%. So that probably excludes most privately run companies.
So if you go live in Singapore or Dubai, you'll pay less tax as an investor in our share market than a local on a capital gain on an Australian business.
Correct. You could effectively pay nothing. You can also receive franked dividends. They're basically tax-free as well. So if you line this up, you probably want to go to a country where they don't tax foreign income, or foreign income is taxed very concessionally. And you could ultimately have no tax payable on your investment income while still having investments in the Australian stock market.
So the irony there, if you believe in Australian companies, which the ASX 200 is definitely not as appealing as other markets. When I mean other markets, the US tech stocks obviously drastically outperform our local companies, just because they're domestic companies versus global international tech companies. But if you're one that wants to support ASX top 200 companies, you're better off moving overseas to invest in them. And the path to do so is looking quite appealing.
Well, yeah, if you're after tax, if your tax rate now just doubles, which it has with these new changes, I think it's a strong consideration to actually think about. And if you move into a jurisdiction where, you're paying no tax, Middle East, Dubai, whatnot, or you're moving to Singapore, top tax bracket's $1 million there for an individual, you're only paying 25%. It looks pretty attractive from where I'm standing.
And there's lots of countries in the world that have these low tax environments to attract migration. Even there's that island in between France and England, Jersey, which I'm pretty sure it's 0% capital gains tax and is it 10 or 15% income tax? And and you can, I think even somewhere like Monaco, but Monaco, you've actually got to live there and buy a property, I believe. But yeah, there's plenty of loopholes globally where people could relocate and be somewhere on, somewhere like the Mediterranean Sea in Europe. So I think that's a bit of an unintentional consequence where we are seeing people seriously consider it. So you're seeing that in your business, your clients are seriously considering it?
Yeah, I think so. I think it's a bit harder with the exit tax with established businesses, but surely if you're thinking about starting a new company up, the question is, well, why would you, if you can leave Australia and set it up overseas, why would you stay in Australia? With the CGT discount, previously US, I think their average tax rate is about 23% on founder-led companies that you pay on exit. I think UK is about 24%. Australia was 23.5%. We now go up to 47%. We go up to the top of the global rankings. Founder-led companies. It's not very attractive. You have the experience potentially in your field of expertise. You're getting a pretty good salary, I guess, because you're at a high level. Why would you take that risk of many years of under market salary to get the long payoff, only then to lose half of it at the end of it? Now, I know Dr. Jim Chambers says the small business CGT concessions are there and all that sort of stuff. Yes, they're still there. They came in 2007. The thresholds there were $2 million for revenue and $6 million for net assets. That hasn't changed a single dollar since they came in.
Oh, wow.
So I think you need to throw a carrot in there and have a look at those thresholds. But by removing the 50% CGT discount, that was an element in your tax calculation that you can actually put into that calculation of the small business CGT concessions. So all the concessions actually stacked. So by removing the 50% CGT concession, yes, you can still use the small business CGT concessions, but with the 50% discount gone, the end goal of that will effectively make your tax bill double. So it's still not tax-free. The consequence for whatever the end goal was, it was still double in taxes by removing the 50% discount. So the business community is a lot worse off.
The other thing that we're witnessing in the business community is, if you were thinking about retirement in the near future, this has kind of accelerated that consideration because you'd rather recognise that gain before June next year. So people approaching retirement are now thinking, well, they're either going to go get a valuation on the business by June 30, and then hopefully it's at an optimal level where then the gain from there on is incremental. But if it's not, and it's hard to get a valuation, sometimes expensive, you're exposed to a much higher tax on your retirement plan, selling your business and moving, let's say, overseas. So some people are now considering selling up and retiring sooner rather than later, right?
Well, yeah, it's a strong consideration. Like if you had a timeline of 5 years of wanting to exit before these budget announcements came in, some of those calculations of after-tax gains may actually have changed a lot. So if you've got 50% CGT discount coming out, then your after-tax returns and what you thought you had in retirement may have been dissipated. There are some rules there that do protect. So the 30 June 27 is still available for CGT discount. So you can rely on that still and peg it to a valuation at that time. So I think any business owner should definitely get a valuation at 30 June 27 without fail. And then the gains after that are done under the indexation method, subject to minimum 30%.
So providing you get a good valuation June 30, hopefully you can minimise the treatment under the new system.
Yeah, so you can put that portion of the gain, I guess, under the CGT discount method. You probably don't want to go above $6 million because that net asset value test. But yeah, you could still apply all that. I think for small businesses, the small business CGT concessions are probably where you're still going to get the large majority of your tax concessions, especially under 15-year retirement exemption. But yeah, those 2 million the revenue turnover test and the $6 million net asset value test. I think if the government was fair dinkum about helping out small business, they'll definitely have a look back at those thresholds because I'm sure Theo back in 2007 buying a $6 million home was very different than buying a $6 million home now.
It's true. Yeah, it's crazy. A $6 million home in Sydney doesn't go that far.
Yes.
You used to think that $6 million and your home and hose in a nice mansion.
Yes.
It's not quite the same anymore, which is a crazy concept. So just to conclude some of these points, we sort of already covered superannuation, but I just want to just highlight why it is now a more attractive vehicle that we're seeing more and more interest in already, even just in the several weeks since the budget. We're seeing sort of strong engagement and inquiry on setting up an SMSF and potentially buying property in SMSF. For every $6 invested in superannuation, $1 of that $6 is in residential property. So clearly, people still believe in investing in property within super. Those tax treatments, we mentioned it: 15% income tax and 10% capital gains tax during the wealth creation phase. But then once you enter retirement, it's tax free entirely, both income tax and capital gains tax, right?
Yeah, that's correct. So as long as the amounts you have in super on a pension phase are less than, I think it's $2.1 million now, any gains or income effectively tax-free.
Now, what we like about it from a lending point of view is that that's a non-recourse loan. The loan is excluded from your balance sheet. So sometimes people purchasing investment properties in their personal name or in a trust, still with a personal guarantee, need to factor in that debt into their personal balance sheet, meaning that even if it on paper is cash flow neutral or positively geared, it can still have an adverse effect on your borrowing capacity just because of buffers and whatnot being supplied to debts, meaning that purchasing an investment property could somewhat limit your ability to purchase a home or upsize a home. That's purchasing an investment property outside of super. Buying within super negates that risk. It negates that issue that the debt that you use toward property investment is not going to have an adverse effect or limit your ability to upsize a home or buy a home. So that's a big one. You do pay a premium for that. There's a higher rate because it's a non-recourse loan. On top of that, we do have lenders that look at income in super very differently to your personal servicing. So if you haven't been contributing historically to your superannuation significantly enough to justify servicing or past servicing requirements, we do have lenders that will actually take an accountant's letter from someone like Brad on a commitment to make a higher contribution moving forward. So obviously that commitment needs to be somewhat realistic. If you're earning $100,000 a year, you can't say you're going to put $50,000 a year into super. There's sometimes a caveat around 10 to 15% of your overall income, depending on the lender and depending on your situation. But yeah, that for several reasons, that's now becoming more appealing. What's your views on all that?
Yeah, there's been a lot of innovation in the SMSF space, and let's call it innovation by the non-Big Four banks because they're not actually in that market anymore. But as you said, the lending is sort of ring-fenced within the self-managed super fund structure, so it really doesn't matter what your personal credit history is like. It's just really fundamentally, is the property going to wash its own face along with the contributions that you're going to make? Obviously, if you're doing it with an accountant's letter, you're generally going to commit to that. I would think you're not going to go into this, with a shortfall and then effectively blow your whole super portfolio up. That just wouldn't be too smart. But there's also things like offset accounts now that historically weren't available in a self-managed super fund environment. That's been a new tool available for SMSF investors. And something that's probably a little lesser known is you can actually borrow from a related entity or yourself as well. So it doesn't actually have to be with one of these other entities. So that's something that you could also look into in setting up a limited recourse borrowing arrangement with yourself or a family trust or a bucket company.
Now that's worth mentioning why an offset is also so appealing for an investment property in superannuation. If you accumulate significant equity or achieve significant growth in an investment property in your superannuation, you can't use that equity to reborrow against for another investment purchase. So same thing then can happen if you pay down the loan, you can't redraw the funds. So having an offset account is very opportunistic, let's call it, because if you pay down the money in the offset account rather than paying down the loan, you can withdraw those funds and use them for additional investing, let's say in shares or whatnot. So it is crucial to make sure you do find a lender with an offset account. Lastly, just to wrap up all those changes, trusts, going back to it, something that we didn't really touch on. Well, there's two things there I want to touch on. What is the purpose of a trust now moving forward? Some people are questioning. There was a whole lot of questions in that Q&A session in our webinar about whether a trust does even make sense to invest in anymore. And I believe there still is merits to investing in a trust for asset protection reasons, right?
Yeah, that's right. It probably doesn't make sense from an income tax point of view anymore. When these new taxing or trust rules come in, you're going to have a minimum of 30% tax to pay. It's a non-refundable credit which flows through to beneficiaries. If you stack that side by side with a company, you're going to have still a 30% tax rate, but you are effectively going to have a refundable tax credit. So all the upside is with companies from that point of view, and you also have the ability to retain profits. Now, if we look at sort of restructuring your trust and putting it all in a company, one of the downsides in doing that is if the person actually becomes a shareholder of that particular company and you've got a fair amount of wealth, it means that now sitting on your personal balance sheet is shares which you own in this XYZ company. Now your personal balance sheet is also adjusted to the value of the shares which are owned by this investment company. And so that may not be ideal for asset protection purposes. You may have borrowings in your own name. You may be directors of other companies. For whatever reason, if you have creditors come after you in a personal capacity, then effectively the shares which you hold in this investment company can come into play from that point of view. So historically, a family trust has been good because it gets that investment off your personal balance sheet. So going forward, I still think they play a role, especially if you're sort of, got a lot of assets in your own name. You may want it off your personal balance sheet for that very reason. But it just wouldn't be a vehicle which you would distribute through from an income tax point of view. And you can sort of achieve an outcome by, issuing dividend-only shares, for example, at the shareholder level to pay directly to the individual rather than via the trust.
Which is a perfect segue to the rollover window. So there's a 3-year window now. If you want to make changes to assets, as in transfer assets from a trust into a company and not pay capital gains tax. So if you want to review your structures, hence why accountants are going to be very busy for the next 3 years, you have 3 years to do some tax planning sessions and figure out what is best for you in this situation, given all those considerations you just mentioned. Yeah, well,
the rules for that aren't actually out yet. So all we know is that there's going to be a transitional rule for 3 years. As to what the devil in the detail, we just don't have any idea. I hope it's going to be as simple as if you have any assets in a trust, you can move it to another entity, and it'll be as simple as that. That will make a lot of sense. But yeah, I just really don't know what it looks like. So we're waiting for those rules to be issued, and we're hoping it's going to be that simple. There is also going to be some admin costs involved and some time costs. You've got a new entity structure. If you could move across to a company, you're going to have to set up new bank accounts, potentially new ABNs. So there is a bit of red tape that you're going to have to overcome and get over. But yeah, there is a transition rule. We just don't know what the detail is yet.
And the problem there, it works for shares because, shares, if you transfer from a trust to a company, the capital gains tax is the only thing to consider. Doesn't work for property because you're going to have to pay stamp duty, and stamp duty is a state tax, and there's no exemptions from state government on the federal budget changes.
I don't think there will be. So yeah, property is going to be a big problem because you've got those state taxes that are going to be paid. Also, if you're operating a business via a trust, it's not as simple as just moving into a company and setting up a company and going from there. Once again, you'll have a new ABN, you'll have to have a new bank account, all the customers you'll have to contact, all the suppliers you'll have to contact. Huge, time resource and also admin resource that's required in order to move to this structure.
So lastly, wrapping up, it'd be remiss of me not to talk about the macro sort of climate right now, what's going on. I'm sure you've got your 2 cents to say about where we are in the economy from a inflation, interest rate, unemployment point of view. So just to spell out the lay of the land, it looks like we have hit the peak of the interest rate cycle, in my opinion. We did call this out in our podcast earlier this year that we said that there were no more rate rises to come. We might be jumping the gun here, but it looks like unemployment is rising. We did call that out as well at the start of the year when we said that it was about 4.1. Now it's 4.5%. And inflation is somewhat sticky. It's come down a little. Depends what sort of measure of inflation you follow. But it's going to be a bit of a predicament for the RBA and in the not too distant future, where they're going to have to choose between high inflation or high unemployment. And I think the latter will be the priority, tackling high unemployment, because high unemployment can lead to, distressed vendors and people being forced to sell properties that, are taking prices they don't want to take. And that has a subsequent impact and flow-on effect to the economy in terms of spending. And then, I guess, the GDP and the general shape of the economy, things are starting to slow down on a per capita basis. I think if we were reporting on a per capita basis, it is negative growth at the moment. So, at the end of the day, I know your focus is on tax, but I'm sure you've got to look on a lens on feel of the economy. How are you feeling, your clients are, or how do you think your clients are feeling in the current economic state?
Oh, they're definitely, the environment's been a lot tougher than it was or has been like in the last 6 to 24 months. I think the path forward is going to be a lot harder. The growth is probably not there. The good times are certainly behind us, and then coupled with less take-home money because of more taxes, it's really tough. If you look at sort of unemployment, we've probably been increasing unemployment, especially if you take out sort of all the government jobs that are being added, and that itself has been some sort of welfare. So, the government's, I think, going to find themselves in a tricky situation. Inflation is still very sticky. It's not ideal. Are we into the interest rate cycle? I'd like to think so, but generally the RBA is looking at sort of inflation as a proxy, and I still think that it's probably a little bit too high from where they want it, but demand is coming off. But we'll just have to see. Like, I think inflation in this sort of environment is sort of driven by businesses just needing to raise prices to compensate for less customers, really. So, we'll have to see where that falls out. But I think the environment's pretty difficult. It's pretty difficult from an investment point of view, whether it be property, shares globally. Employment confidence is not that great from a private sector point of view. And I do think the government has been hiring them, and spending a lot more in sort of employment for, I guess, jobs that may not necessarily have to be jobs, but I think they're just trying to impact the overall unemployment rate.
Yeah, interesting times ahead. We're in the opposite cycle, it looks like, from a monetary policy point of view, to the US Fed. They look like they're about to increase rates, where our forecast is changing. I think most of the major banks, bar one, is now forecasting a rate cut, but not till next year because of your point. All eyes are still on inflation, and inflation is still within that hot zone. Anything else worth mentioning about how your investors are feeling, I guess, in terms of business activity, right? Like, we're seeing that businesses are hurting in our world. What we're witnessing is that consumer spending in some sectors is definitely down. It's weird how inflation's so hot when spending in certain sectors is definitely feeling the pinch. That's because obviously inflation is driven at the moment by supply constraints. It's more things around electricity, housing and rents, and fuel and energy and insurance. It's not really driven by what the monetary policy of the RBA can influence. How does it feel to business owners, would you say?
Oh, I think certainly anybody in the consumer discretionary sort of market are feeling a pinch. Hospitality is a pretty tough place to be at the moment.
No one's drinking alcohol, which is where they make their money.
Well, they might just drink 1 pint for the whole night, Theo, so sit on it. But, $15 to $20 a beer is pretty rough. Add in a $30 pie,
Yeah. I can't believe there's someone I know who will remain unnamed, but they own a restaurant, and back in February on Valentine's Day, it fell on a Saturday this year, they had a restaurant fully booked. Every table was booked. But out of the, let's say, 25, 30 tables, 3 tables were drinking.
Yeah.
How do you make money?
Well, how do you make money? Like on a public holiday, you got to pay somebody to wash the dishes $78 an hour. That's pretty tough sledding. So, look, I know somebody in hospitality that owns one of these establishments, and they've decided they'll roll their sleeves up themselves. That's a lot of money to forego, right? But it's pretty tough. We've seen some pretty marquee, establishments close. We've had Key, which is probably one of the best restaurants that Sydney's ever had.
Yeah,
They're
iconic.
Closed.
Yeah,
iconic. He's been around for many decades, and Peter Gilmore there said, "Mate, we can't even make money if we don't do 150 covers in a single night." Which is, if you've been there, it's a pretty expensive place, but. That's a pretty telling sign, I think, for hospitality, that a global establishment like that's well renowned for their food and fine dining cannot make any money if they don't do more than 150 covers.
Probably since they put FBT tax on entertainment for all the corporates that went down there back in the day.
Yeah.
We can talk about the tax implications all day. But, Brad, I think that's a wrap for today's session. Thank you so much for coming on board. Really appreciate your time and your valuable insights. And hopefully you can come back in the future as a repeat guest of ours.
Sounds great. Thanks, Theo, for having us. And I've had a ball. Thanks.
Thanks, Brad.